A lot of countries around the world are about to go bankrupt, and millions of people are faced with dire consequences due to their inability to pay off their massive government debts. This phenomenon is caused mainly by the actions of the Fed, and in this video we'll cover the dire economic situation the world is facing. Also, we'll cover the way the different countries are tackling these problems and issues. And if you stay until the end of this video, you can understand the ways you can protect your wealth, and not only protect, but you can also build up your personal wealth. Hello and welcome to the Market Watcher, a place for education about our most relevant and important economic topics. Subscribe to the channel if you want to gather knowledge about the financial and economic world which is surrounding us. As always, everything said is with educational purposes only and should not be considered to be financial advice. One of the biggest problems facing the world is the massive amount of debt which is taken upon by almost every single country. These debt burdens are starting to take a toll on a lot of different regions, especially the poorer parts of the world, such as Sri Lanka, a lot of African countries, and the Middle East, as well as Southeast Asia and Latin America. Emerging market bonds face a $237 billion of cascades of defaults, Bloomberg reports, with Sri Lanka already stopping its payment to bondholders this year. Russia stopped in June. Now El Salvador, Ghana, Egypt, Tunisia and Pakistan are cited as particularly vulnerable. As history shows, the collapse of one government can create a domino effect with their traders pulling money from shaky markets. This happened in the 90s with the Asian crisis, which then transformed into the Russian default of the late 90s, and after which came the end of the dot-com bubble in the United States. Currently, Ghana is of particular interest as it is Africa's second largest cocoa and gold producer. Now Ghana is seeking financial assistance from the International Monetary Fund for access of up to $1.5 billion to shore up its finances and win back access to the global capital markets. As you can see on the provided infographic by the Visual Capitalist, we see the severity of the high debt to GDP ratios of most countries around the world. A lot of developed countries have high debt to GDP ratios like Spain, Portugal, France, Italy, Belgium, the United States, Greece and Canada. All of those countries have ratios which exceed the 100% mark, which from a historical context is insane. Just for perspective, according to history, every single time a country's debt to GDP goes above the 130% level, that country has defaulted on its debt, or if they have the privilege to print money, they hyperinflate the currency and economy. As you may know, if a government has an established central bank and its debts are denominated in its own currency, the government and central banks cannot default because they can always repay the old money with newly printed money. But this leads to an inflation, and the inflation is what eats up the debt. Just for some more context, let's give an example. The problem with the $237 billion of emerging market debt is that it is denominated in dollars, which means that these countries cannot print dollars and just repay them back, and in their case they can and most likely will default on the dollar denominated debts. And the current debt situation is getting much worse with the fact that the dollar is at a historic all-time high compared to other currencies, which means the dollar is getting stronger compared to other currencies, and people and countries need more of their own currency in order to repay the same amount of dollars. For example, 1 year ago, if we owed $10 of debt and our currency was euros, the rate of USD to euro was 1.2, which means we needed 8.33 euros to repay the $10 worth of debts. Now the USD to euro rate has momentarily dropped below parity and it sits at a level of 0.99, which means that to repay our $10 worth of US debt, we need to have 10 euros and 10 cents. The same goes for all other currencies which are falling in value compared to the dollar. In the case of the more poorer emerging market countries, not only that they cannot repay their debts with a weaker dollar, now the dollar is getting stronger, which makes the debt burden even worse. As the head of the International Monetary Fund, Kristalina Georgieva, said recently, what we see now is a crisis upon a crisis and possibly a third shock of tightening of financial conditions to come after the pandemic and on top of the war in Ukraine. Surging prices have forced central banks worldwide to tighten monetary policy. In the United States, the Fed's officials pivoted to aggressively lifting rates to tame the hottest inflation in 4 decades. This monetary shift is what has supercharged the dollar. Meanwhile, developing nations have amassed $250 billion pile of distressed debts that threaten to drag these countries into a historic cascade of defaults. Nations that don't earn the US currency but have to service debts in the greenback are finding it twice as hard to keep up, Georgieva said, adding that about 30% of developing and emerging market nations are either in or near debt distress. 3 out of 10 countries around the world currently have or are about to have a massive debt burden problem, and with much more domino effects to come, the world is not looking bright. The debt problem will bring less economic growth and much weaker economies. In other words, the world is about to enter a recession. During recessionary times, gold has been traditionally considered a safe haven asset, with many investors and central banks turning to the yellow metal during recessions and times of turmoil and distress. So let's see now, how does gold hold up when the economies tumble? Since 1971, when President Richard Nixon ended the gold standard, we can examine that gold prices and their relationships with the economy are quite interesting. From 1971 until 2020, we had 7 official recessions. On the next chart and graph, you can see each recession and the performance of gold and the S&P 500 index. During the first recession in 1973, which lasted 16 months, gold gained 87%, while the S&P 500 lost 13.1%. Then in the 1980s recession, gold lost 5.1% and the S&P gained 6.6%. Here the recession lasted for 6 months. In 1981, the recession was again with a 16-month duration. Then gold gained 1.6%, while the S&P 500 gained 5.8%. In the 1990 period, gold stayed almost flat with a 0.1% rise, while the S&P 500 gained 5.4%. The recession was 8 months. In the great dot-com crash and the following recession of 2001, gold gained 5%, while the S&P 500 dropped by 1.8%. In the 07-08 period, gold was a huge safe haven when it rose by 16.3%, while the S&P 500 plummeted by 37.4%. The recessionary period was 18 months. During the very brief recession of 2020, which lasted only 2 months due to the enormous amount of money printed by the Fed, gold gained 5.6% in 2 months, while the S&P 500 dropped by 1.4%. Currently, since the start of 2020 until early summer, gold has dropped by 2.1%, while the S&P 500 has tumbled by 19.6%. But officially for now, we are not in a recession. In the coming months, we expect the US to enter a recession officially. Officially, a country enters a recession if it has 2 months of negative GDP growth. Since 1971, when the gold standard was abandoned, gold has largely seen positive price changes during recessions. And in the last 3 recessions since the 2000s, its performance has countered that of the S&P 500 index. While the increase in value has not been dramatic, this helps cement gold's position as a hedge against financial turmoil and as a store of value. Gold has a low to negative correlation with the stock market, suggesting that changes in the price of gold are largely independent of how stocks are faring. As a result, gold is considered an effective diversification tool for investors who want to hedge their bets. The smarter central banks and governments around the world know that from a historical context, having more gold makes their economies much more financially strong. Global central bank gold reserves topped 35,500 metric tons, approximately 1/5 of all gold ever mined. The vast majority of central bank gold holdings were acquired in the last decade when national banks became net buyers of the yellow metal. According to a survey made by the World Gold Council, 61% of global central banks are stating they expect to increase their gold reserves over the next 12 months, and what is very important, no single central bank has indicated they would sell gold, unlike the 2000s when the majority of central banks were net sellers. The current economic situation could be quite positive for the gold market, and we will examine the future changes and market moves. With this, we end the video. Subscribe to the channel and hit the bell icon if you want to be truly financially educated. Goodbye for now, and I'll see you in the next video.